Now let's get to a big warning from a big bear. Investor Jeremy Grantham says the stock's super bubble that he warned about previously has yet to pop. The GMO co-founder sees more trouble ahead due to what he calls a dangerous mix of overvalued equities.
In this market environment, it is important that you listen to this advice by Jeremy Grantham.
First of all, the most important principle to me is that the great bubbles are quite different from ordinary bull markets. And if you average in the others, you get a lot of dilution and you miss the point. The great bubbles, most of them 2.5 sigma or 3 sigma events, are 1929, 1972 is kind of an honorary member on the cusp. 2000, the great tech bubble.
As an experienced investor, he's worried about certain market segments being overhauled, especially in artificial intelligence. We'll break down his predictions and what it means for investors in a straightforward overview. Keep watching. Investing in stocks can be challenging due to the cyclical nature of markets, with periods of both prosperity and decline. Renowned investor Warren Buffett famously remarked, "Investing is simple, but not easy." A notable example is the late 1990s, where the S&P 500 experienced a booming period from January 1995 to February 2000, yielding 25.8% annually. Another market cycle occurred from October 2002 to October 2007, characterized by a 15.5% annual return. This boom, with a Cape 10 of 27.3, ended in a bust from November 2007 to February 2009, resulting in a cumulative loss of 51%. A more recent example is the boom and bust from 2019 to 2021, where the S&P 500 returned at 26.1% annually, reaching a Cape 10 of 38.3. However, from January to September 2022, the market experienced a decline, losing 23.9%. Jeremy Grantham, co-founder of GMO LLC, has recently expressed concerns about a potential market bubble. With a background as a seasoned investor, his insights carry weight in the financial world. Grantham's worry centers around the possibility of certain market segments being overvalued, suggesting a correction or market downturn. Grantham highlights the emergence of a mini bubble in artificial intelligence, questioning if the excitement around generative AI could impact the market's final stage. He draws parallels to historical market cycles like the late 1990s and the 2008 financial crisis to provide context for potential future movements. The co-founder emphasizes both short and long-term impacts of AI, acknowledging its immediate influence on the market while expressing concerns about its long-term risks to humanity. Grantham aligns with the idea of regulating AI, reflecting broader discussions on responsible tech use. Grantham's reliance on historical comparisons and emphasis on long-term risks of AI provide valuable perspectives, but investors should approach predictions with a critical mindset. The financial community must remain adaptable to navigate uncertainties in the ever-changing economic landscape. In a few years, there is a 70% possibility that the stock market could crash, according to Jeremy Grantham, co-founder of GMO LLC. The British investor said in a July 1 interview that equities have a 70% chance of collapsing in the next few years due to an asset price bubble that is about to burst. As you are aware, I'm only fascinated by truly massive bubbles. The U.S. stock market's 3 senior bubbles are 1929, 2000, and 2021. We have essentially crossed out every box, he remarked. Grantham also discussed the similarities between past stock market collapses and the current one, noting that equities rose for nearly 10 years in nearly ideal economic conditions before seeing a dramatic decline. Thanks to the recent tech boom fueled by investors' excitement for AI, he downgraded his initial estimate of the market's likelihood of another bubble collapsing from 85% to 70%, he said in the interview. Grantham expressed his concern about the emergence of a mini bubble in artificial intelligence, stating that he remained uncertain if the enthusiasm for generative AI could influence the final stage of the stock market's bubble. He speculated that it might have already prolonged the process. Grantham suggested there was a slight chance that it could mitigate the bubble to result in only a modest decline. Looking ahead, Grantham acknowledged the potential long-term risks posed by advances in artificial intelligence to humanity. He concurred with the idea of regulating artificial intelligence. He cautioned that there is a window of a year or two for a more traditional bubble to lose air. A conventional recession, a decline of profit margins, and some stock market distress before the substantial effects of AI become apparent. Grantham emphasized the importance of addressing these issues before the real impacts of AI come into play. Jeremy Grantham's predictions about the market underscore his apprehensions regarding the growing influence of a mini-bubble in artificial intelligence. Grantham, a respected figure in the financial world, has raised questions about whether the excitement surrounding generative AI could significantly impact the concluding phase of an ongoing stock market bubble. In the broader context, Grantham recognizes the transformative potential of artificial intelligence and the associated risks it poses to humanity. His advocacy for regulating AI aligns with the broader discourse on responsible and ethical use of advanced technologies. Looking ahead, Grantham issues a warning about the potential evolution of more traditional market dynamics. This includes a gradual deflation of the bubble, a routine economic recession, a decline in profit margins, and anticipated market distress. His emphasis on addressing these challenges in the short term suggests a pragmatic approach to navigate potential market uncertainties. Not so many years ago, Grantham predicted a decline in the market. He issued a warning to investors in January 2018 that the U.S. stock market was in a bubble that would burst and that they should get ready for a rough ride. He said then that there might be a short-term melt-up in the market, with prices increasing sharply before a big drop. In the beginning of 2018, he contended, the U.S. stock market was displaying many of these traits, with prices surging to all-time highs, valuations at previously unheard-of levels, and indications of speculative excesses, like a rise in initial public offerings and high margin loads. Grantham said that the market was in a melt-up phase, during which prices would climb steadily until finally declining, rather than it would crash right away. He maintained that when the bubble finally broke, investors who were obliging and did not get ready for a possible market downturn would probably lose a lot of money. Some market participants were skeptical of Grantham's warning because of the robust economic fundamentals at the time, which included low unemployment, excellent corporate earnings, and steady economic expansion. Grantham, however, stuck to his prognosis, claiming that high valuations pose a sizable downside risk and that economic fundamentals did not always translate into excellent stock market gains. Grantham's caution about a market bubble and the possibility of a market collapse turned out to be accurate. Later, in 2018, the market saw a substantial decline, with the Dow and S&P 500 plunging 12% and 14% respectively in the fourth quarter. The Nasdaq saw its largest quarterly decline since 2008, plunging 17.5%, while the S&P 500 and the Dow posted their worst quarterly results since 2011. A number of factors contributed to the decrease, including worries about interest rates going up, trade disputes between the United States and China, and concerns about a recession in the world economy. Grantham's ability to identify market bubbles and caution investors about potential downturns stems from his meticulous examination of historical market patterns and a profound understanding of market cycles and their driving forces. He consistently argues that investors lacking an understanding of historical market context and the risk associated with elevated valuations are more prone to substantial losses when bubbles inevitably burst. In his 2018 alert regarding a possible market decline, Grantham advised investors to brace for a challenging period and adopt measures to safeguard against potential losses. He recommended reducing exposure to high-risk assets like U.S. equities and high-yield bonds while increasing allocation to defensive assets such as cash and treasury bonds. Grantham underscored the significance of adhering to a long-term investment strategy and avoiding the allure of chasing short-term gains. According to him, investors who maintain discipline and focus on long-term goals are better equipped to navigate market downturns and capitalize on emerging opportunities. Grantham's insights not only reflect his concerns about the current state of the market, but also underscore the need for proactive measures and a careful evaluation of the evolving landscape, especially in the face of emerging technologies like artificial intelligence. As the market continues to evolve, Grantham's perspective serves as a valuable contribution to the ongoing discussions on market dynamics and the role of transformative technologies in shaping the future. Leave your comments down below and do not forget to like, share, and subscribe to this channel before you leave.